We, the people in the house. What up? What up? What up? So check it. We are going to talk about today, my people. This is a hot topic. Gather in, my people. Gather in. This is the United States, private enterprise free state. In on the check on. So are y'all ready? Are y'all ready for this? Are y'all ready for this? All right, people. I know it's early in the day, and y'all are probably not even up yet. So check it. We're going to get into this. This is the 2025 tax filing as a sole prop, my people. Sole prop, sole proprietor. That is the best way to go. Sole prop, sole proprietor. Okay, when filing these taxes, if you're going to file, you filing as a sole proprietor, my people. So we got multiple methods on how you can file as a sole proprietor. Okay, I'm going to break it down clearly for you. All right, so check it. The direct expense deduction, my people, you deduct the full cost if it's ordinary, necessary, directly related to business. Examples, my people, supplies, software, advertising, professional fees, office expenses. You know what I'm saying? So whatever happened in that 2025 year, anything that was paid or incurred. You know what I'm saying, my people? Let's get into it. Depreciation, spread it out. Instead of writing it all off at once, you deduct it over time. That's up to you. Used for vehicles, equipment, computers, furniture. Common methods, my people, are straight line and MACRS. Okay. Section 179, election, accelerated write-off. Okay. Allows you to expense large assets immediately instead of depreciating. Works for equipment, vehicles over 6,000 pounds often qualify more. Machinery, certain software. You know, it must be used for business, 50%. It must be used for business. Bonus depreciation, another accelerated method separate from the 179 method. Now you can deduct large percentages up front, often used when 179 limits are hit. You can phasing down over time, but still it's powerful, my people. Okay. Home office deduction. Two ways. Simplified method per square feet. Actual expense method, percentage of rent, utilities, insurance, repairs. Must be regular, exclusive, principal place of business. But you got to remember your name, the ens legis, the taxpayer, the all caps, is the sole proprietor. It's the taxpayer. And you flip your name backwards, it is the sole proprietor. It's the business. Vehicle expense, two methods. Choose one, not both. A standard mileage, IRS rate per mile, simple low audit friction, actual expense, gas, insurance, repairs, depreciation, registration. So you can deduct all of that as a sole proprietor under the SSN number, not the EIN. You don't want to mix it up because the taxpayer is the sole proprietor. Often better for high cost vehicles. Accountable plan for owners. If you operate through an LLC, corporation, trust, you can reimburse yourself tax-free for mileage, travel, meals, home office. These shifts expenses off personal returns. So it shifts the expense off the personal returns if you're doing it under an LLC, a corporation, or a trust. Okay, meals, entertainment, partial. Meals generally 50% deductible, 100% if provided to employees required by business operations. So if you fed the people and if you fed your employees, if you had other business required operations, that's all 100% deductible on a sole proprietorship. Entertainment itself is usually not deductible, but food tied to it may be deductible. Education and training, deductible if it maintains or improves existing skills, is required for your business. Examples: courses, certifications, seminars, coaching related to your field. So, all the people that are sole proprietors and doing this process, you can write this off as a sole proprietor, that you had courses from the gurus that you paid money to, seminars of the gurus that you went to. You can write that off in your sole proprietorship. Coaching related to your field. So if you're doing this process and you needed coaching on how to get through the process with status correction, you can write the fees off that you paid to whatever company, whatever guru, you can write it off. Startup and organizational costs. Before the business even makes money, formation costs, how much, the legal setup, the market research, all that money you get back that you spent out for a loss in your sole proprietor or your gain. Up to 50,000, up to 5,000 immediately rest amortized. Bad debt write-off. You invoiced, included it in as income, and never got paid. So most of the time when you're doing your OIDs, it's income. Some people say it's not income, but you can read the directions and then you have to apply it to how it falls under the sole proprietor. So if you're doing OIDs, it's going to have to be income on a sole proprietor tax return. Or you're going to have to show invoices, or you're going to have to show where you never got paid. That's why you have to have 1099 OIDs and 1099Bs. Retirement contributions, indirect write-off. Not an expense, but reduces taxable income. Some solo 401ks, SCP IRA, simple IRA. These are very powerful for high earners. So if you got, your high earner, there you go. Loss carry forwards. If expenses exceeded income, losses can offset future years, sometimes other income depending on structure. Capital loss treatment. Some expenses may be capitalized, later written off as a loss when disposed or abandoned. So, loss and abandoned, you got to do you a 1099A. If you abandoned it, now you coming back for it. Reclassification strategy advanced. Some personal looking expenses become deductible when. Some personal looking expenses become deductible when properly documented, allocated, reimbursed, assigned through an entity or a trust. Structure matters here. So basically, there aren't just ways, there are layers, my people. You can deduct, You can depreciate, you can expense, you can reimburse, you can amortize, you can offset, you can carry forward. So, you know, if you need some help with that, we do in a consultation, 407-300-5377. The consultation is a $25 consultation for 25 minutes to get these taxes right. So if you so basically your sole proprietor actually gives you more flexibility than people realize if you use it correctly. So we're going to talk about the legitimate ways that a sole prop can write off expenses. So Schedule C, ordinary and necessary expenses. That's how a sole prop, begins to write it off. And here are some of the common categories people use. So advertising and marketing, bank and merchant fees, software subscriptions, phone and internet business percentage, office supplies, professional services, insurance, business portion, repairs and maintenance. So repairs and maintenance, car, vehicle, house, home, whatever you did, you can get all that money back that you spent out at the beginning of the year. So we got a tip on a partial use, deductible by percentage, not all or nothing. So basically, we move on, home and office. So they got two methods that we can use. We can pick up the better one. So the simplified one is a $5 per square foot up to 300 square feet. Actual, you deduct a percentage of rent or mortgage, interest, utilities, internet, insurance, repairs, HOA fees. So you can make all those deductions with the sole prop, vehicle expenses. You can either use a standard mileage, that's the IRS rate, times business miles, clean, simple, audit friendly, or you could use the actual expense, often bigger, gas, maintenance, insurance, registration, depreciation, interest on the auto loan. So all the money that you paid in your auto loan for that year, you can recoup that back. You can also recoup the registration every year back. You can recoup all the money that you spent in your car insurance, mortgage insurance. You can recoup all of that back. You can recoup all your gas if you put it on your bank statements, or if you have paid cash, you have to have saved the receipts. So if the vehicle is used 50% for business, this adds up fast. It's 50% for business. So remember, your sole prop, your Ensligas is the taxpayer. The all caps is the taxpayer. That's 50%. And then you have the business part, which is the sole prop, your name backwards, last name, first name backwards. So basically, that's the other 50%. So you're doing the 50% on your name, last name, first name, because that's the business of the sole prop. So you can do a cell phone and internet. You could do your business line, 100% deductible. You can do personal phone, business use percentage. You can also deduct that, the hotspots, the data plans, everything you paid for in that phone, you can deduct all of that back, plus the monthly fee of the phone. So, and all that has to be done on a 1099-A, B, OID, not a C, because you're not canceling it out. You paid for it up front. Now you're getting the money back, and it was income. That's what the beauty of the sole proprietor is. So, you got your meals. So client meals, 50%, meals while traveling, 50%, meals required by business crew, long shifts, sometimes 100%. You got to keep notes on all of what you're doing when it comes to your meals. Travel expenses, fully deductible when business related. So, flights, hotels, rideshare, baggage fees, rental cars, tips, all of that you can get back, but it has to be related to business. Personal days must be separated, but business days still count. So if it was on a business day, it counts. And if you are doing business every day, 7 days of the week, every minute, all of that, it counts. So education and training, deductible if it proves existing skills like courses, coaching, certifications, books, subscriptions, conferences. And we just talked about that. So if you're in this field trying to do your status correction, all the courses that you paid for, all the coaching that you paid for, all your certifications that you paid for, meaning your DBAs, everything that you paid for, books and subscriptions, and the conferences that you went to for learning how to do status correction and everything, learning how to do taxes, learning all of this, you get it all back. Not deductible if it qualifies you for a new profession. Equipment and tools. You get 3 write-off options. Expense immediately, Section 179, depreciation. Examples: computers, cameras, machinery, furniture. Insurance. You can deduct business insurance, professional liability, errors and omissions, self-employed health insurance. Retirement equals silent write-off. You can reduce taxable income with SEP IRA, solo 401k, 1K. Not on a Schedule C, but still lowers your tax bill. Startup and a pre-business course. Even if the business wasn't official yet, the domain, the logo, the research, the legal setup, marketing test, you can deduct all of that. As a sole proprietor, up to $5,000 immediate deduction. Bad debts, if you invoiced, counted it as income, never got paid, you can write it off. Loss and carry forward, you can carry forward expenses exceeded income. So loss can offset future profits, sometimes other income, very powerful in early years. So we talked about the partial personal expenses. You have a timing strategy advance. You can prepay expenses, delay income, accelerate deductions. The reality check, my people, is the IRS doesn't care how many deductions you take. They care about documentation, business purpose, reasonable allocation. Most sole props under deduct by thousands each year. If you need some help with this assistance, you can call up us 407-300-5377 USPEFS, and we will definitely help you with these taxes. Can run a quick we can help you with running a quick expense audit if that's what you need. We can help you estimate how much tax you're going to overpay. We can help with expenses you're already paying. That should be partially deductible. So you would have to call us up and just tell us, is it dealing with home, vehicle, office, your biggest monthly bills, yada. We can give you that $25 consultation for 25 minutes. So they say that real money usually is for a sole prop. Real money usually is for a sole prop. Okay? So all the write-offs that we just talked about, you can do all of the write-offs. You can also write off parking, your tolls, low repair costs, older car, fewer business miles. We talked about that. We talked about a vehicle you probably forgot. Vehicle you probably forgot, my people. Mileage to bank, post office, client meetings, supply runs. So if you've been going back and forth to the bank in your vehicle, mileage, gas. Post office, mileage, gas. Client meetings, mileage, gas. Supply runs, mileage, and gas. Business portion, GPS, dash cam, vehicle accessories used for work. Monthly expenses that you can write off, my people: home and office, electricity, rent, mortgage interest, rent interest, mortgage interest, what you paid in, electricity, gas, water, internet, trash, home insurance, HOA, for if it's with the business percentage, cleaning, okay? Phone and your tech, the cell phone, if it's under the sole proprietor, remember the first name last name is the taxpayer, the last name first name is the business. So you write off your cell phone under the business portion of the sole prop, the data plans, the hotspot, the cloud storage, the software subscriptions, website hosting, email services. Banking and money, bank fees, merchant processing fees, payment app fees, interest on business credit cards, accounting or bookkeeping software. All that can be written off. Insurance, business insurance, professional liability, portion of auto insurance, if using actual method. Marketing operations, ads, printing, business cards, domains, branding, subscription, office supplies. All that can be written off. Meals, client meals, 50% written off. Meals during work, travel, 50% written off. Example, monthly snapshot. So you have to have a monthly snapshot, your bank statements, however you keep your records, because you're going to have to show them to the IRS when you do a sole prop return. Your car cost, your phone, your internet, your rent utilities, software subscriptions can add up, for example, $1,055. You got to know what you're doing with the figures. One of the biggest mistakes, my people, is that people try to deduct everything at 100% or nothing at all. The correct move is allocate, document, be consistent. That's what holds up is being. You must allocate, document, and be consistent. So, my people, remember that your first John Doe and Doe John are the same taxpayer as long as it's a sole proprietorship. It reports under your SSN. You're not claiming it's a separate legal person. Name equals new name order, new entity. So it has to be sole prop, first name last name first, are the same taxpayer. Now, how should it be handled correctly? IRS Schedule C, name of the proprietor, John Doe, exactly as it is on the SS card, the SSN card. Business name is your last name, first name. This is treated as the DBA trade name. SSN, your SSN. So the IRS cares about the SSN match, not the word order. The SSNs must match the name. So is Doe John a DBA? Yes, functionally. So you can operate as Joe Don, which is the last name, first name, invoice as last name, first name, advertise as last name, first name, but for tax purposes, it all flows back to the first name and last name, which is the social security number, SSN, which is the taxpayer. In your state, if your state requires a DBA filing, it's down at the county clerk. That's a state compliance issue, not a federal tax validity. Bank accounts. Best practice, account name, last name, first name, owner, first name, last name, SSN on file. That aligns everything. So, what aligns everything with the bank account is the account name is last name, first name, owner, first name, last name, the SSN on file. 1099s, you receive if someone issued a 1099 to last name, first name, SSN is yours. So your fine reported on a Schedule C. If the SSN is wrong, that is what needs correction. Then you have to correct what you just did with that SSN. Expenses and deductions, my people. All business expenses paid under first name, last name, or last name, first name are they still deductible as long as you paid them. They were for the business. You can explain the connection. So you have to know what you're doing when you talk to the IRS about your tax refund as a sole proprietor. So basically, my people, think of it like this. First name, last name equals the taxpayer. Last name, first name equals the brand. So the taxpayer is your first name, last name. The brand is last name, first name. So it's totally normal and it's totally allowed. It's totally flexible. If anything is misaligned. So you bring it back into alignment as first name, last name. You're the taxpayer. Last name, first name is the brand, the sole prop, the business. So if y'all need help with that, we can help you out, set you up with them Schedule C's, set you up with them DBAs, you know what I'm saying? Align your vehicle with the monthly expenses under the last name, first name as the business. So, you got to give us a call, 407-300-5377. The USPEFS is here to assist. We do have the consultation, $25 consultation for the 25 minutes. So this is something key. You need to probably write it down. Remember, your first name, last name, taxpayer. Your last name, first name is the sole prop. So that's how you would set your DBA up. So even if the car was purchased, the loan was signed, the title registration are all in the first name, last name, the personal name, but it can still be a business vehicle under last name, first name. So everything is 50-50. And especially if you control the taxpayer, then the sole prop is even stronger with the last name, first name. If you got it copywritten, you need to get it copywritten. Okay, why is this allowed? For sole proprietors, assets do not need to be titled in the business name. Contracts do not need to be signed in the business name. Loans are almost always personal. The IRS only cares about who uses the vehicle, how much it's used for business, how it's documented. So, mm, not whose name is on the loan. How you properly claim the car. Treat it as a contributed asset. Treat it as a contributed asset. You don't file anything special. You simply use the vehicle for business. Track business use, deduct expenses on Schedule C. This is called owner contribution of property. So you can choose your deduction method. We already talked about that. So, what the IRS would never argue, okay, they will not say the car isn't in the business name you signed personally because sole props don't have separate names in law. What does matter? You need a mileage log, consistent business use percentage, expense tied to the car, same method year to year, unless rules allow change. That's it. One important warning, you don't actually, that you accidentally will hurt yourself with, my people, if do not claim that last name, first name is a separate entity. Do not claim that the loan is not yours. Do not claim that the car isn't yours. That causes contradictions. So, if the car's in the trust name, then that's not a contradiction. But if it's in your sole prop name, it's a contradiction because the sole prop name is one and the same. And the sole prop takes on all the liability. So for tax purposes, the clean statement is I, John Doe, use my personally owned vehicle in my sole prop last name, first name. That's bulletproof, my people. Say it for you again. I, first name, last name, use my personally owned vehicle in my sole proprietorship, last name, first name. So that's what you would have to use as a statement. So basically, you sign personally normal, title in your name, still deductible, yes, still business vehicle, yes. If you need some help, my people, give us a call, 407 300 5377. Okay, so that is it for this session today, my people. We about to get on up out of here. This is a public announcement from the United States, private enterprise free state. And the topic today was 2025 tax filings as a sole prop. Go back, listen to it, give us a call, 407-300-5377, the United States, private enterprise free state, and we are out. Oh, hold up. Peace to all my people. Um, Ellen, peace to Ellen, peace to Dakota, peace to all the other people in the private chat. Stay up, stay one, stay strong, and we are out.